Hi, welcome to the channel. Today we're diving into one of the most mysterious and misunderstood corners of the financial world: hedge funds. What are they? How do they work? And why do they have such a big reputation? Let's unpack everything you need to know. First off, what is a hedge fund? A hedge fund is a pooled investment fund that uses a wide range of strategies to earn active returns for its investors. Think of it like a private investment club, often only open to wealthy individuals and institutions that can invest in almost anything: stocks, bonds, derivatives, real estate, currencies, and even art. Hedge funds are usually more aggressive than mutual funds or index funds, and they often aim for higher returns, but with higher risks. So, how do hedge funds work? Hedge funds are managed by professional portfolio managers who charge fees in a format known as 2 and 20. That means 2% annual management fee and 20% of any profits earned. They use strategies like long-short equity, buy some stocks, bet against others; global macro, betting on interest rates, currencies, or geopolitics; arbitrage, exploiting price differences in markets; high leverage, borrowing money to amplify returns; and risk. Now let's talk about some famous hedge funds. Here are some well-known hedge funds you might have heard of. Bridgewater Associates, one of the largest hedge funds in the world. Renaissance Technologies uses quantitative and algorithmic trading. Citadel, a global giant in multiple asset classes. Pershing Third Point, known for activist investing and turnaround plays. So, who can invest in a hedge fund? Hedge funds aren't for everyone. You typically need to be an accredited investor, meaning you earn over $200,000 a year or have a net worth of over $1 million, excluding your home. And most hedge funds require minimum investments of $250,000 or more, sometimes even in the millions. Now, why are hedge funds risky? Because hedge funds can invest in almost anything, use leverage, and short stocks. The risks can be huge. Some hedge funds have made billions, while others have lost everything. For example, Long-Term Capital Management, LTCM, collapsed in 1998 and nearly crashed the global financial system. Archegos Capital imploded in 2021, causing billions in losses to major banks. So, should you invest in a hedge fund? For most people, the answer is probably not. Hedge funds aren't necessarily better than index funds or ETFs, and many actually underperform the market, even with all their flashy strategies. But if you're ultra wealthy and want access to niche strategies or private deals, they could be worth exploring, with a lot of caution. Now, alternatives to hedge funds. If you're curious but not rich enough for a hedge fund, here are some alternatives. Hedge fund ETFs like HDG or QAI, active mutual funds with alternative strategies, robo-advisors that offer risk-adjusted portfolios. So to recap, hedge funds are private investment funds for the wealthy. They use advanced strategies to aim for big returns. They're high risk, high fee, and not always better than simple investing. If you learned something new today, smash that like button, subscribe for more investing breakdowns, and drop your hedge fund questions in the comments. I'd love to hear your thoughts. Thanks for watching. And remember, sometimes simple investing wins the race.